We're down today for the 4th day in a row for the 11th time in the past 13 trading sessions. So most every day of the past 3 weeks we've been down to the downside. Are we going to go down to lower lows? That's the question. We had that initial surge to the downside with the extreme 4 standard deviation move. We bounce, as we typically do off extreme moves, and now we're retesting. We still haven't got to lower lows yet. Will we? I'm going to talk about that today. We got a rare pattern on the Russell 2000 that we haven't seen since March of 2009. I'm going to show you what that pattern means and other similar patterns that we've seen since and what the market's done afterwards. And then today's trade idea looks for a bearish opportunity in a sector that's struggling, that's not doing so well, in a stock that shows us a bearish pattern. We'll talk about that. So let's go ahead and get started. Today is Monday, October 22nd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click that logo right there, or mouse over that logo. Then click that red subscribe button that pops out. That will subscribe you, get you notifications whenever we post these videos. Also, click the thumbs up icon that's right down below the video. That tells me 2 things. Number 1, you liked it, you got something out of it tonight. Number 2, you want us to do it again tomorrow. Really quick, one-click way to give us feedback. You can do that right now while you're watching. Remember also to comment further below on anything that stands out to you from tonight's video. Join our daily Market Outlook email list. There was like almost 100 stocks on our watch list today in that email. Click that link that popped out in the top right corner of your screen. That will subscribe you really easily there. Follow me on Twitter for more content like this throughout the day. And also join our Market Outlook community that we created on Facebook. All right, well, let's take a look at the S&P 500 with the market forecast indicator here, as we always do to start off. And you can see the intermediate line is still rising, but though barely. I mean, we've gone from 30.66 to 30.72 to now 31.16. So it is rising. We are, in the middle of a near-term pullback. This is now day 2, and we did dip below 20. I mentioned before, I wouldn't be surprised if it dipped a little bit below, similar to this, just because of how volatile the index is, or volatility is right now. Normally you don't like to see it dip below 20, but you can see the pullback. In fact, we've been down now 11 of the last 13 days. We're gotten down to that 2750 level. I'm still holding the 2750 level on this second bounce back. So again, the question is going to be, do we bounce off of a higher low? We've even suggested the possibility of a divergence, and now I would venture to guess now how low the near-term line is here, that you probably won't get a divergence down to 2700. So, if we break through this little pennant formation, the big decline, sideways trading action here, if we break through this to the downside, then you're looking at a continued intermediate trend, the market sentiment line falling down. And then 2700, of course, is your next. That's our last intermediate low point. So, as bearish as we've been, we're still holding the last intermediate low. In fact, we're still above it. We're still holding the 78% Fibonacci retracement of the last intermediate run. So we're not bearish enough yet to drop below. Someone mentioned before, I saw someone that said like, let me know when we break 2700, because that's when things get bearish. Until then, the ups and downs are simply because of the higher volatility, which I agree with completely. You can see that the Dow, same thing. You've got this little pennant formation forming. Now, the expectation now of these pennants is that you do break to the downside. So, we'll keep that in mind. That is an expectation for this pattern. Though I don't expect that to happen, that's what you would expect to happen. And you can see we're not even close to the old intermediate low point on the Dow, so it's holding up at a higher Fibonacci level. In fact, it's holding, let's see which one it is. If you were to go from here all the way up to that high point, we're at that 62% Fibonacci retracement, kind of right in the middle. So we're still, there's some old highs and some old lows. 2500 is a big number. So you still got that support holding. The NASDAQ composite, also very similar. It actually was up today, and its intermediate line turned back up. And then finally the Russell 2000. See, the NASDAQ composite's market sentiment line's dropping below 60 now. the Nasdaq, the Russell has its market sentiment dropped below 50. Now, all the other major indexes dropped below 50 earlier this year. The Russell didn't. It actually held up pretty well during the previous decline. The Russell outperformed. And then, of course, it's been lagging here. And you can see we've got six clusters in the past 2 weeks. We haven't had that many clusters in such a short amount of time. I mean, you have to go all the way back 10 years. And if you look at the different instances that we've had over the past 10 years, you can see, for example, here was a cluster of clusters. We had 4 in a couple of weeks there. And over here you had a cluster of clusters. You had 5 in a couple week periods. You can see both of those cluster of clusters led to a rally. This was August of 2017. This was the election, November 17. You can see here you had, now remember on early 2016, the 50-day moving average was below the 200. So you had the death cross there. And these were more space. You had 4 was the most there. So again, you remember how we had that move. We were actually forming a lower intermediate low point because we had that intermediate run, then we bounced, then we had this one. And on this one here, you can see we had 3 there and 1 there. So to get 6, you have to go all the way back. You know, there's like 3 and 4 and 5, all the way back to here. 2009, we had 10 clusters in a matter of 13 trading sessions. So 3 weeks, we had 10 clusters. And then, of course, that set the low point, the low point of all low points. And we've been headed up ever since. So, you know, you can see when you get clusters of clusters like we're getting right now, especially when we're not as bearish, right? Here, you know, this was the second leg down of a long-term bearish run coming after this one here. All these others you can see were just the one intermediate line down, and then we bounced. So, you know, to get as many clusters that we've been getting is actually a very positive sign. To get them so bunched up together, so close together, because that's what oversold clusters do. Overbought clusters, you know, you can see we had a bunch here. That's more rare. For most of the time, you get one every so often. They get a lot more spread out on the upside, but they cluster up together on the downside. And when you get a cluster of clusters, it ends up being a positive sign, at least on major indexes. Individual stocks, you can keep going down, 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 right? Because of their own individual problems. But when you got indexes with lots of stocks, when you get a cluster of clusters, that's actually a bullish sign. All right, a reminder before we look at some other charts here that you can watch our market outlook on our blog. There's a little bit of a summary here up above, a link to discuss with other market scholars right above it too. You can see our class schedule here on the right. Brandon is back. He taught his top-down trading, top-down trend trading class earlier today, and he's got this is his class later this evening, and tomorrow is very popular dividend growth investing class. Remember, if you want us to keep doing these videos, click these 3 things. Number 1, click this heart right here. That opens up your Twitter account. You can click on the like button. That likes tonight's Market Outlook tweet. You can like tonight's Market Outlook post on Facebook by clicking this image. That takes you to your Facebook page. Of course, you can also click here. This is the 3rd click that likes this post here. Remember, you can share this post with others either on Facebook or on Twitter or on LinkedIn by clicking on either of these buttons. That lets people know that they should check it out, right? That you found it valuable, you think it would help them out too. As I mentioned before, you know, we're not getting, if in fact I have to go to Russell 2000, we still don't have that death cross. We're still holding. We got that long upper shadow last week, and we'll see how things end up this week. This is different from that early 2016 period. This is where we got those clusters. See how more bearish we were on a long-term basis. The MACD was below 0, which means the 50 was below the 200. It was way below 0. We're not getting, you know, this is more, you know, similar to these other patterns where we got the cluster of clusters here and the cluster of clusters here, and we didn't get any clusters here, if you remember. So these were the other times where we got those cluster of clusters when we tested the 50-day moving or 200-day moving average. You can see all the other major indexes. There's the S&P still holding above its 200-day, similar to what we saw before. The Dow is well above its 200-day, and so is Nasdaq is still holding its 200 days. So important long-term support levels for these major indexes where we're sitting. we still have the 2 red arrows, MACD and the stochastics is still green. If you take a look at the 2-line version, excuse me, here of that, you can see we're still below the 8-day moving average. We're still quite a bit below the 8-day moving average. In fact, if I were to show the MACD, this is the MACD of the 8-day versus the 17-day. But if I were to show here, excuse me, let's change the MACD here, right there. And we're going to change, instead of 8 versus 17, we're going to look at today's price versus the 8-day. And you can see, again, this big, big discrepancy we have. We dropped sharply down. Again, very similar to what we saw in that late March period, which I've shared before, the similarities. And you can see we dropped sharply down, bounced up, came back down again, and then we rallied. And you remember the convergences here, the convergences back to the upside they're not slow. They tend to come up sharply. That doesn't mean we can retest soon, but they tend to, you can see even that one came up sharply back up towards that moving average. Then we came down to a much smaller level and bounced. And you notice we really haven't even seen the long lower shadow. Those long lower shadows, those are the days where the wheels come off. Everybody thinks the world's going to end, and then buyers come in late, and that sets the bottom, right? You see that so often. I get all the tweets and the DMs how the bear market's starting, that we're falling off the cliff. And, that all happens intraday on these days when you get the long lower shadows. And then that sets the low point, right? That usually sets the low point. We haven't seen that yet. So we might need that long lower shadow to touch 2,700 only to bounce back up. I thought we might get that today, especially on the futures contract, because we had started down. We ended up with another long upper shadow here, but we were, we actually started down and then rallied on the intraday basis. Here you can see it on the 1-day chart. Here we go. We started down. Whoopsie, gap down. We got all the way down to 2,750. Again, that's when I got the alerts, right? I've got people letting me know that that we're starting the bear market, and of course, as soon as I get those, what happens? We rally back up to 2,780 or beyond overnight. And now we did fall back here in the early morning. We've been converging, so we'll see if we end up holding this or not. But that's why I thought we'd get that. I thought this would end up being a longer lower shadow that ultimately was not. So once we get that long lower shadow, then that's obviously going to be the most bullish pattern out of all of these that we're looking at. All right, the intraday move, you can see we ended up with a lower high and a lower low. We did not get below last week's low point, though. As bearish as we were early this morning, we did not get below last week's low point. So kind of trading near the bottom and trading near yesterday's or Friday's low point, but not breaking through. Smaller trading range, if you see, here's this chart here. Smaller than average trading range. So if we let's go to SPY. It had less than 3 points, so 2.95. Volume only at 82 million, so very low volume too. You put that in the context here. 80 some odd million, that's down here. So below average. 2.95 points is also below average. Still above 1%, right? But still below average numbers. So, again, you're going to see these lines start to come down as long as we, have trading ranges below 3 points. Now, eventually you'll get a bounce back up because volatility is so high. Volatility still remains at elevated levels, near 20, and in the bearish zone here around 1. But see, not extreme. And this is what happens, right? We've seen this pattern. I've shown you this pattern before. After you get the surge, then you do get higher volatility. It's not as high. And we start to moderate. It takes a while, but we start to moderate that volatility. Because it's so high, you will get bigger moves here of like 3-4 points, off of this low. But the more that you get volumes below 100 million, the more you get trading ranges below 3 points, the more likely these lines are going to start dropping. And these lines start dropping as you bounce, as we go back higher. And as the ATR gets below 1% of the current price, so that's 2 3/4 points, then again, that line's going to start coming down. So, you know, again, we've seen where these lines have come down before, and as they start coming down from these elevated levels, that's the low point. That's when it gets set in. It's those big 150 million, you know, 1.5 times the average volume, you know, with big trading ranges. Those are the days we worry about, and you can see we had a couple of those, but since then we haven't, right? Since then, the only really big significant range that we had was on an up day, right? Even that day was a reversal of that evening star I've shown before, similar pattern that we saw over in this, where was it? Over here, this day right here, very similar pattern. You get a big up day, you get a reversal of a down day, but not to new lows, and we'll see if we end up bouncing and holding this or not, or if that pennant formation forms and we break out to the downside, similar to the way we've moved to the upside. I don't expect that to happen, but that's what the technical pattern would suggest. Of course, I think there's other factors here, other technical factors and fundamentals, and how extreme this move was, that would suggest it would actually be that we're belting out a low here, similar to this, you know, and the same thing here. But we got down really sharply, and then we had some volatility around the lows before we set it and moved higher again. So to summarize, the intermediate line's rising, but it's showing a weak bullish posture. So that's not strong enough yet to stop this intermediate run we're having to the downside, which still has not gotten to low intermediate low points. Volatility remains high. We're getting a cluster of clusters on the small cap index we haven't seen since March 2009. But we have seen similar cluster of clusters that have marked low points before. So we're getting a lot of volatility right now, and that's typical. Typical when we have a big extreme move and big surge in volatility, and we try to hammer out a low with some ups and downs. Again, the expectation remains that because of all the extreme technical factors we saw before, that this will end up bouncing off these levels and moving with the seasonal trends back to the upside. Of course, what do you think about that? Do you agree with that? Do you disagree with that? Click that link in the top right corner of your screen and then hit either agree or disagree. If you click disagree, scroll to the bottom and comment down below on what you're thinking and what you're seeing. That either suggests that there's a really good chance we'll break down to the upside, or that we'll V-bottom off of this. That, you know, we're not going to get the big ups and downs. That, you know, the next near-term balance might be the one that takes us up higher. I don't think necessarily that's the case, but maybe you do because some things you're seeing. So let me know down in the comment section down below. All right, now let's take a look at what's driving the price action today. Over here on the left, you can see emerging markets and the dollar and commodities all rallied. Those aren't the typical asset classes you see together, either at the top or the bottom, but they all rallied today. Growth stocks holding up. Look at the downside losers you had. You had value stocks, dividend stocks, real estate stocks, you know, all dropping. You can see yields were higher a little bit. TLT was down. Yields were higher, and you can see IEF, which is that 7 to 10 year, that was actually relatively flat. But interesting to see that you have these kind of interest rate sensitive areas all down the most, and really kind of safe haven areas down the most. So not really the most risk off day. Even gold was down today with the strength in the dollar. When those two are up together, like we've seen during that really big surge, typically that's when you're really worried, when they move up together, and you also have short-term bonds up there. But that wasn't the case today, and so again, another sign that we're not as bad as it may seem. You can see crude oil, you know, all these equity asset classes are down so much over the last 2 weeks. If you look at just today and who outperformed today, let's go to a 10-minute time frame here, make the chart a little easier to read. You can see this is coming off of the gap. Small cap stocks had the worst performance today, down 1.3. Let's see, IWM, where is that? Over here, down 1/4%. So something's up with IWM there, the percentage on that one. But you can see on the other end of the spectrum, emerging markets are up today. Crude oil was up today. And all these equity, including bonds and gold, were all down. So not your typical risk off pattern. And you can see one of your biggest losers over the past, you know, for this year to date so far, was China. And China had your best rally Brazil had another really good rally too, and it is now starting to turn around a little bit. But look at EEM, Indonesia, South Korea, Poland, all these really big losing emerging markets showing some pretty decent gains, sprinkled in with some other areas too that haven't been down as badly. On the other end of the spectrum, Europe continues to struggle. Mexico down a little bit. Turkey still down. So not all in India, not all emerging markets fared well today. It was really kind of focused on those Asian areas, in particular in China over there. But your developed markets all still struggling. Germany, UK, France, all struggling here. And if you take a look at the 12 grid for the foreign markets, the 12 biggest economies here, you have another cluster on Japan, you have another oversold cluster on Germany, another one on India, and all of these, France is at its 3-month low, Canada is at its 3-month low, South Korea is up a little bit but at its 3-month low, Brazil is the one that's doing much better. The S&P 500 is one of the only ones that has a bullish posture, and China now is kind of breaking out of this low and hammering out. And you remember, in the next, I believe, my opinion is the next maybe 1 or 2 intermediate rallies we get will most likely not be because of U.S. strength. It will be more these international markets rallying like we've seen before. I've shown you this chart before with the 3-year weekly chart. We've got clusters on the weekly chart. We did before too at the beginning of 16, and then we had 2 years of outperformance, so 16 and 17 of these international areas coming off those oversold weekly clusters. That's also brought the S&P 500 up with it. So here's the ratio of that, and you can see right here was the last time we got a bunch of clusters on the EM. We had a good rally, a little bit of a pause at the end of 2016, but once the new year 17, look, 2017 was a great year for international stocks. But you can see they really outperformed the S&P 500. But the S&P 500 over that 2016-2017 time frame. You can see here, so there's 16, there's that weakness right here at the end of 16, the election, right, and that's when emerging markets had a big drop in weakness. The S&P took off, but then throughout 2017, as bullish as the S&P was, these international stocks did much better, right? They rallied more. So when we do get these next rallies, I don't necessarily think it will be the S&P fueling the way higher, with the Fed's raising rates. And all of that, and I tweeted out today too. Remember the real rate of return, the Fed funds rate minus the inflation rate, is not at levels where we would suggest a recession would be occurring anytime soon. They're still actually really close to zero. The average for when recessions start is like 400 basis points. So we're at zero. We're really, really close to 0 basis points. So there's still opportunity even with the Fed rising. Remember, the Fed stopped raising rates in 2016, and the market didn't peak for another 18 months or so. Later in 2006, 2007. And you remember even then, commodities in these late cycle sectors didn't peak until the middle of 2008. And then that's when everything really started to fall off the cliff at the end of 2008. So, obviously not anywhere close to that kind of a level yet. Alright, so while staples and utilities are holding up over the past couple of weeks, with real estate up there too, with this 4.5% decline in stocks, you can see today it was technology, discretionary, and communication services that all led the market. Industrials, small outperformance too, but all these other safe haven areas and dollar sensitive areas were all the losers today. And you can see energy material still really declining with the strength in the dollar, and industrials as well. Until that dollar rolls over, you won't see relative strength in those areas yet. And as I mentioned before, as we figure out this low point and we get that initial surge higher, it will be these areas, your technology, discretionary, and communication services, that will lead that way higher before rotation, those late cycle sectors, industrials, energy, materials, take their cue. But they won't lead a bounce off of a low point. Typically that doesn't happen. It will be these more high beta, higher momentum names, the ones that you expect. They will lead us off the low point until we get the intermediate trend intact. then we'll get that sector rotation. But again, another sign that today wasn't as risk off as you would expect, because you normally would see these down at the bottom, and then you would see staples, utilities, and healthcare, which are all lagging the market today. You'd see those up at the top. One of the area of the market here that's been struggling is that food area, and you can see Archer Daniels Midland had a decent run the last few days, getting up to an area of strong volume, but obviously was not able to push through. Also hitting the exponential moving average in between these Bollinger Bands, and really showing a bearish candlestick pattern here today. If you take a look here, there's your kind of an engulfing type pattern. You can see the move higher, and you can see the near-term line forming a bearish high point and rolling back down. So the momentum line dropping back down to an extreme low, the intermediate line rolling over. The long-term chart shows potential for it to run down towards that 200-day moving average. You look at some other indicators like the directional index here. It hasn't had either the blue or the orange line below 20 for a while, and usually one or the other is going to be down there with a rising ADX. Now, if that's the case, if the ADX starts to rise, and which one of these will fall down right now, you'd have to guess on the blue. It doesn't mean it has to happen, of course, because anything can change. But you would suggest you would look for the blue line to head lower, especially with, like I said, the Bollinger Bands and the volume that are showing up there. The 3 green arrow chart for Archer Daniels Midland, you can see back to 3 red arrows after this bounce back down with the stochastics rolling over. Looking at the 2-line versions, you can see that the stochastics rolled down a little, still not below its moving average, and you can see the price got up to that 17-day and then came back down below the 8, so back below the 8. So you look for a bearish trade opportunity. You have earnings coming up, so you do have to be aware of that. You can go out to a time where volatility is not very high yet. See, the volatility is higher at the points where the earnings is. These other volatility levels are much lower. And if I were to go further kind of in the money here, or even just at the money, volatility is even lower there. So if I were to buy that put and then position size around the whole cost, I mean, that's less than $2. That's not very much. I can position size around that whole cost, knowing that I probably will take half of the loss. But you want to position size just in case there is an earnings that really wipes it up to the upside, right, and wipes this put out. Then you can say, okay, well, I'll position size a 1% risk if that's my normal risk around that full $1.79. And if earnings, kind of fizzles out and the stock really doesn't go up or down, then I could probably take half of that loss. So I end up taking a 0.5%, so half of normal. But I position size, I have enough in there, so if the stock does drop sharply, then towards the 200-day moving average, towards that next layer of volume support, then I can take advantage of it with this put. So, again, a bearish trade opportunity to add some balance to our portfolio in an area that's been weaker and it continues to be weaker. Down below the moving average again. Any bounce that we expect would not be centered with gains here. It will be more in these other technology areas until some of these other sectors take over, and eventually when this takes over, there might be a much better opportunity, much better yield to be able to get into a long position on this. But until then, we'll take advantage of this bearish technical pattern that we see and see if we can get a short-term gain out of this with this short-term put opportunity. Alright, so now I want to hear from you. What do you think about tonight's trade idea? What do you think about the outlook? What do you think about the discussion on what's driving this price action? We got a busy week this week. Remember to click that link that just popped out in the top right corner of your screen, and let's chat about what you're seeing and any questions or comments you have on tonight's video, or any questions or comments on anything we didn't talk about in tonight's video. As always, thank you very much for watching. I appreciate your time tonight. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment. Follow me on Twitter for more content like this, and then join our Market Outlook community that we created on Facebook if you haven't done so already. So again, have a great evening, everybody, and we'll see you all next time.